Welcome back and welcome to Tax Tips with Tax Guru, where our leading guru is Mr. Vikas Garg, CPA PC. With this heavy tax season on hand, we are in a panic state. I say calm down and visit your friendly CPA. He will put your mind to rest in peace. Anyway, our tax expert, CPA Vikas Garg, is located in Ashburn, Virginia, and today he pays a visit to our studios. Let's see what information he has to offer to us today.
Good morning, Washington, D.C. Again, November, December, we heard about tax cuts, tax cuts, tax cuts. Last week, February 10th, we talked about Section 199 deduction, that is 20% of business income as a deduction. So, let me just summarize a little bit and then we will go forward. If your income is $100,000, you can take a 20% flat deduction of $20,000, you are going to pay tax on $80,000. There was some requirement of qualified business income or qualified taxable income. If you are filing as a single, your income should be less than 157,500, or if you are filing as a married filing jointly, your income should be less than $315,000. Last week we talked about how you can save the money when your income is below the threshold. Now question comes, I am a high income tax bracket, my income is above the threshold. What should I do? Can you suggest any tax planning? How should I come out from this plan? Answer is, if you properly plan, even if you are in higher income tax bracket, you can save the money. First important factor is you need to forget about the past. Whatever tax strategy you were using last 30 years, it is all waste. It has to be change everything. First thing, let us say I was a 1099 employee, I and my wife both are IT professional, we were getting the income under the 1099 and our both of combined income was $400,000. Till date, we have a single member LLC and we were keep filing Schedule C, no issue. I do not want to spend overhead, I am pretty simple, I do not want to take headache, I keep filing the Schedule C income. Now, under the old traditional method, you are perfectly fine till 31st December 2017. 1st January 2018, you have a section 199A deduction of 20%. As your income is above the threshold, you cannot claim 20% deduction. What should I do? Is there any tax planning I can do to get this 20% deduction? Answer is yes. Let us discuss about how to beat this income limit. Once you exceed the income limit from the specified limit, only issue is your calculation is going to be a little bit complex. You need a proper tax planning to make sure you can claim it. First thing, what are the rules? Let me first explain the rules. The rules are 20% of qualified business income or 50% of your W2 wages. How much W2 wages I should draw? Till date, I saw many times people are saying my salary is 30,000, my salary is $40,000, I do not want to pay Social Security, Medicare, I will keep minimum as a W2 and maximum as a profit distribution. That strategy was working in past, but if you continue same strategy, you are going to lose the money. How it is? So, first thing is, look at your 2018 estimate. You don't know how much? Let us look at your 2017 income. At least you can make some rough estimate how much income you are going to make in 2018. Look at that income and plan it. How much W2 wages I have to do, how much business profit I need to show. When you are drawing W2 wages, make sure you have the full audit proof of the amount. Okay. First thing, what includes in W2, or when we talk about W2 wages for section 199A, it may have different meaning what it shows on your W2. So, let me talk about what it should be reflect. W2 wages are total wages subject to wage withholding, your deferred elective or your deferred compensation. Second part, W2 wages do not include any amount that is not properly allocable to the qualified business income as a qualified item of deduction. If you cannot claim a W2 wages as a expenses in your business income, that is not your qualified W2 wages. Okay. Next important factor, many times we saw people forget to file their W2 or W3 with the Social Security office. Your payroll provider or any of your tax professional or anything, they forget it. After 1 year, you get the letter from Social Security office, you are missing your W2. It is very important. If you forget to file your W2 with the Social Security office, which is due 31st March of each year, they give you 60 days grace period. Make sure your W3 was filed with the Social Security office. Social Security office do not charge you penalty for late filing, but if you file late now, there is no penalties, there is an indirect penalty stating you cannot claim 20% of the deduction. So, simple thing, make sure you are filing all the payroll related forms on time or lose the section 199A deduction. Let me give you simple one example for the high net worth people. Let us say your income is $1.2 million. Out of this, your qualified business income is $200,000, where you have withdrawn $120,000 as a qualified wages. So, we got three numbers: our family income 1.2 million, qualified W2 wages 120,000, qualified business income 200,000. What is my 199A deduction? First thing, 20% of qualified business income, that is 200,000, equals $40,000. Second, 50% of qualified W2 wages, that is 50% of 120,000, that is $60,000. So, your section 199A deduction will be $40,000. If you continue same thing under Schedule C, your qualified business income is 0. If you convert as S corporation, your qualified 199A deduction is $40,000. So, if you are on 35% tax bracket, you are losing a deduction of $40,000, means you lost $10,000 by not doing the proper tax planning. So, simple thing is, if your income is above the threshold, make sure you are writing a proper W2 income. Next part, I do not have a W2, I forget to create a W2. Is there any other options I can use it? Answer is yes, but with a limited condition. What it is? How much property you have in the company. Simple thing. Let us say you get a 0 qualified business income unless you have wages or you have a qualified property. What is qualified property means, or how do I define what is my qualified property? Qualified property means the asset which is held for use in a qualified trade or business in the during the year. Even if you buy in the December, that is fine. Even if you buy on 31st December, that is still fine, as long as it is used in a respective calendar year. Second thing, it has to be used for qualified business income, means you have one kind of business and you are investing in another type of business which is completely separate kind of entity. No, it has to be under the same line of business. Third thing, it has to be a depreciable asset. Let us say you bought a office condo which including the big land. I invested $2 million in land and a building. Can I claim everything? Land is not depreciable. You need to find out how much is your building cost basis. Whatever is the building cost basis, that will fall under qualified business property. Next part. So, how you calculate what is my income or what is not. So, let me just take about one simple example. You have a income, let us say same we talk about $1.2 million. You did not withdraw any salary. Can I claim a deduction? Answer is yes, if you have a qualified business property. What are the rules and regulations for qualified business property? The qualified business property rules are, you need to take total cost of the qualified business property, take 2.5% of that qualified business property. You can add as a either or option. What are the rules? You need to look at 20% of your defined taxable income and 20% of your qualified business income or 25% W2 wages with 2.5% of unadjusted cost basis of your property. In the same example, if there is no salary and you have a $1 million of depreciated qualified business property, even without W2, you can go 2.5% of $1 million, that is 25,000. You can compare 25,000 with 20% of my business income, that is $20,000, sorry $40,000. So, you can claim 40,000 versus 25, you can still qualify. Next question, I am a doctor, I am a professional or I am a CPA firm, can I use the same tax strategy? Unfortunately, you are not the preferred group. We as a CPA are not counted as a preferred group. We cannot use for us, we have to pay taxes. We cannot claim 20% reduction in our own tax, but non-preferred where you are not in service like CPAs and doctors, all other professions are allowed to claim 20% reduction. That is really a good news. So, simple thing, whether your income is below the threshold or above the threshold, proper tax planning can give you 20% of profit as a deduction under section 199A. Main factor is write up of business, defining how much salary I should withdraw and how much profit I need to keep, and making sure you are giving full audit proof as your salary amount. Thank you. Have a nice day.